Good morning, welcome to Ainslie News. It's 4th of June, Friday. Welcome to the end of the week. Today we're talking USD spikes, precious metals fall, but the impossible Trinity remains. Last night saw the biggest daily gain for the US dollar since September last year on the back of better than expected employment figures via the ADP, ahead of the all-important NFP employment figures tonight. The USD index jumped 0.65% and back above 90 to 90.5. I'll show you in that chart next. The spike saw nearly all financials in the red, and USD gold smacked down nearly 2% and back under the $1,900 line to $18.70. Silver was down over 2.5% and back under $28 to $27.53. The Aussie dollar dropped to 76.6 cents on the back of the USD rise and cushioned the falls in AUD terms to 0.8% and 1.4% respectively for bullion. Here's that chart here. The employment figures saw first-time jobless benefit claims fall to 385,000 last week, the fifth week in a row of falls and the largest since the start of lockdowns in March last year. Here's that chart showing that here for jobless benefit claims. Whilst great news, including for inflation, it has prompted nearly half of the US governors to bring forward an end to the federally funded COVID unemployment programs from next week, affecting around 4 million workers on a $300 a week subsidy. There is widespread concern that this will not lead to more hiring, but rather slow the economy. The employment data glosses over the fact that over 15.4 million Americans are on some form of government employment benefit, dwarfing that 4 million people. Here's that chart here, just showing that difference there. So how sticky is the stronger US dollar? Global macro insiders Julian Brigden, or Railpal's partner in GMI, has been calling this inflation surge for some time, arguing that it is not transitory, and also calling for a much weaker US dollar, which until last night too was playing out on trend. Does last night change anything? No. Normally an economy this strong should be bullish for equities, but we remain worried about US stocks. They continue to be extraordinarily expensive, and investors remain beholden to growth names that have yet to show any signs of adjusting to the move higher in long rates in nominal terms, notwithstanding a rather volatile attempt at growth or value rotation. There's that chart here showing S&P 500 growth and 2 and 10-year treasuries. Ultimately, if I'm right about inflation, then bonds are sitting in the eye of the storm, and at some point the Fed will have to face its trilemma, or as I call it, the impossible Trinity. I touched on this a little in the Insider Talk session with Raul and also in the May In Focus. Does the Fed hike rates to adjust the pressure of the long end of the curve at the risk of catapulting the dollar higher and threatening stocks, the economy, and the Biden administration political goals? Or does it choose to support bonds, equities, and the administration, sacrificing the dollar? Since the GFC, the latter has consistently been their MO. It was also precisely what happened in the late 1960s. If I am right, then after a bit of pain to demonstrate that their hands are well and truly tied, the dollar will be allowed to take the strain, and our model suggests we could be looking at an extreme decline. To attract, here's that chart here showing the broad dollar TWI, all the way back from 2003 to 2021, just showing that there. To attract the capital the US requires, we will need higher yields or a lower dollar, or some combination of the two. As I've discussed, I believe the trigger for the dollar's next leg lower will be a shift to looser fiscal and monetary policy, fiat to lower real yields. Historically, this has been a toxic combo for the dollar, and given the dollar chart we just shown, will be the catalyst for a major decline. Here's another chart here showing that. Brigden talks about the impossible Trinity we've just shown. This is abundantly evident when you consider that we are now in territory where the total market cap of US shares is now twice the size of the entire US GDP. Just let that sink in. Here's this tweet here and comment from Railpal. As Railpal points out, when measuring things such as market cap of shares against the USD, we are losing the perspective of the sheer amount of that fiat USD that has and is being created. Powell compares these to the US Fed's balance sheet as a proxy for the latter, and it changes the perspective incredibly. The minute the Fed tries to rein in that stimulus, things turn very nasty. This reinforces Brigden's impossible Trinity and the prospect of a tanking USD and rising precious metals. Great insight there from News Today. I hope you enjoyed this week of news. Remember ainslieBullion.com.au for all things physical, ainsliewealth.com.au for all things crypto, and goldsilverstandard.com for our own cryptocurrency built and backed by real gold and real silver. Enjoy your weekend, everyone. We'll catch you on Monday for more news.